brought to you by
Palm Marina Estates, Garuga, where luxury meets lifestyle by the water.
We are glad to have you back. Now look at the horizon. The Wakiso we knew, the one of sprawling bungalows and endless perimeter walls, is being replaced by a vertical reality. Developers are selling a dream of convenience and a lock-and-go security. But as an investor, you're not just buying a dream, you're buying a projected return on investment. Today, we are moving past the glossy brochures. We are asking the hard questions about structural integrity, management seeking funds, and whether owning the air is actually a grounded financial strategy.
We are seeing a surge in developments of high-rise properties across the suburbs in Nigeria, Chira, and now in Lubowa. Are we running a risk of an oversupply, or the generation rent is strong enough to absorb this supply and ensure full occupancy?
Yes, thank you, Wilbur, for that question. I think in terms of supply, I wouldn't be worried if I was an investor into apartments, and the reason is simple. Remember, we're trying to work against a backlog of about 2.5 million
or even more,
or even more units in Uganda. So essentially what it means is the demand is there. The question we should be dealing with is, do we have the right product for the right demand? And I think that's where the mismatch is. But without even fear of being contradictory, I think within the high-end apartment space, we're tending towards an oversupply. Middle income, low middle income apartments, I think there's a lot of space for any opportunities for anyone to play in. Yes.
The biggest silent killer of property value is poor property management. After the developers handed over the keys, how can an investor ensure the sinking fund, but also look through the condominium association budgets to ensure that 10 years from now, the paint is not peeling or the generator is still working?
Yes, again, thank you, Wilbur, for that question. I think what we've seen with the emergence of condominium properties in Uganda is obviously the deterioration of these properties over time and eroding investor value. And I think there are a couple of things that we need to do as a country to address that. One, we are operating under a slightly old law. The Condominium Property Act 2001, I think, needs to be revisited. We need to look at how holistically we can address how you bring together community owners and be able to contribute towards the good of the property. My thinking is we need to revisit the Condominium Property Act, but most importantly, we need to educate people buying into these schemes what commitment you need. Most importantly, to be able to put covenants that are enforceable. A lot of the people who live in these apartments, those who are not paying condominium fees, are your high-profile people.
That's true.
So you have to put mechanism in place, like in South Africa they've done, to make sure people can actually account, they're willing to pay or forced to pay, for lack of a better word.
Moses, a 10% yield looks good on paper, but after the management fees and the communal electricity and all these other fees that come with condominium, take us through realistically, what is the net yield that an investor expects? What does a sub-investor expect to take home at the end of the day?
Yes, I mean, to try as much as possible to answer that question, which is quite interesting, because think about it. If it's Wilbur and Moses, all of us, when we invest into whatever investment, whether it is bonds, equities, our return objectives are different. And our risk appetite is different.
True.
So you can't have a universal return for each individual. Because in your wealth journey, whether you're an individual, whether an institution, all these asset classes tend to play different roles. So if I'm introducing real estate at a certain level, I must have worked out a certain required level of return and say, okay, if I'm not putting my money in a listed stock and I'm putting it in real estate, instead of taking, say, 8%, I'll take 14%. So you already have a predetermined return that you're chasing. So it's unlikely that you find a universal return that everyone should pick, because one, different segments attract different returns, even different locations. So a return you're picking in Kololo is different
in Lubowa, Okira.
Definitely.
Moses, we've had horror stories where investors buy into a project off plan and it sells on the third floor. Beyond the contract, what legal and insurance measures are there to safeguard an investor's investment in case the developer runs out of steam?
Well, again, when you look at real estate or any other investment for that matter, it's risk.
Yes.
It's to the extent at which you can manage your risk.
Yeah.
And using that very, case study where, say, a developer was given money, pre-sales, and then they don't complete the project. Of course, the critical thing in that process is how do you manage the deposits that have come from the buyers.
Yes.
And that's why things like escrow accounts come into play. My anticipation is that with the new Mortgage Refinancing Act bill, is that aspect is addressed fully on how those funds are managed in an escrow account. When does the developer have access to those? Because that's the first layer of protection for the investors. The second layer, of course, will be the agreements, the covenants that come into place. And I think we can learn from Kenya. They've gone way ahead in managing that whole risk, protecting the investors,
the buyers' money.
Yeah, and even you have other layers where they can maybe refer the project to an administrator. All these things come into play. But at the end of the day, I don't think it's anything new to this market. People have been doing this for years, decades, in fact. So I think even as the ministry comes up or the regulator, Bank of Uganda, comes up with regulations relating to how do you manage escrow accounts when you're doing real estate projects, mortgage financing, we should see more stringent measures on how the developers access this money so that there's trust from the buyers, but also the protected investors, because that's the biggest risk that we tend to face in residential developments, offtake and investments like that.
The math of condominium is different because the risk is shared. You aren't just betting on your unit, you're betting on the neighbors and the management committee. It's a sophisticated play for a sophisticated investor. Do your homework, check the titles, and remember, in real estate, the cheapest entry point often carries the highest long-term price tag. Catch us in the next segment as we continue to map out your property journey.